Employee compensation, post-employment and share-based. So the first question is, why do we need this reading? So understand the basic premise. An employee joins you today. You promise him that he would be paid or compensated in two ways. The first one, every year he would be paid a salary of, let's say, 100,000. Second, that after 25 years, when your employee retires, then post-retirement, till the time your employee is existent, as in till the time he lives, every year he would be paid some amount of pension. So the major area of this topic is actually how to think of these pension expenses. That's the core focus. Now the difficulty is that how do you typically calculate this pension after the employee retires? So one very standard formula is, what was the amount of last salary your employee was able to generate or earn into, let us say, 1% or 2% into the number of years of completed service. This is the amount that you're going to pay to your employee. Now the difficulty is, how do you find out what would be the last salary today? So first you will have to start making some assumptions. To figure out what would be the last salary, you will have to make an assumption that what should be the compensation growth rate. That means what is the rate at which the salary of this employee is expected to grow every year. So once we know that, then we can make an estimate of what should be his last salary. We will also have to estimate what would be his years of service. So will he work for you for 20 years, or will he actually quit his job in 10 years or 15 years? So we don't know that. Then second thing that we need to know, that after he retires, how many payments will he expect to receive or will we have to make? And that is a function of his life expectancy. So we will have to also make some assumption with respect to his mortality. Right? So you look at your employee carefully and then you try to make a guess. And if your employee is very healthy, then towards his retirement, put him to a lot of work. So that's how you would figure out, or that's how at least you would guess what would be the pension drawn. Now it's not that only after the retirement you suddenly start worrying about the cash flows. You know that 25 years down the line you are going to need some cash flows. So every year you will also start depositing certain amount into a separate trust. Going forward we are going to call this as pension trust. And then every year you will expect that this pension trust amount will also grow because you're going to expect to earn some return. In fact, you would do a lot of reverse working. So reverse working would be, you will first predict what's the last salary, then what is the amount of number of pension amount that we have to pay him, then what is the equivalent amount of liability we have on the date of retirement, then what is the rate at which your money can grow, and then reverse calculate how much money should we deposit every year. But the whole premise is, deposit your money every year in such a way that that money should automatically be sufficient enough to take care of liability expenses or to take care of pension expenses. Are you following this? Now the cash outflow is going to be, first cash outflow is going to be 26th year from now. So should we consider that expense on the 26th year? Are you following what I'm trying to say here? That the first pension payment would be given to the employee on year 26. So let's say you made a payment of 50,000 US dollar. That is an estimate. So that 50,000 US dollar, is that an expense to be recognized in year 26 or is that to be spread across these 25 years? That has to be spread across, because again matching concept, you are paying him pension because he worked for you for 25 years. Right? And in those 25 years he was generating revenue for you. So in this reading we will learn how to estimate the amount of liabilities to which we are going to call as PBO. So PBO is going to be the amount of liability. We'll get into full forms. We'll also learn how much amount of assets are to be recognized or to be invested onto the balance sheet into the pension trust, and we will also learn how to calculate the annual expenses. Are we okay here? So for the first few minutes, the initial part is going to look a little tricky, especially on the calculation and forecasting liability. But once you get good hang of the initial part, then remaining topic is going to be a smooth ride. There would be one section in the reading where we'll have to go at a very granular level and look at the small difference between US GAAP and IFRS. Otherwise, it's going to be a smooth ride. So roughly, this is the plan of action that we have with the reading. We will look at 3 types of employment benefit plans to begin with. Then we will go on to defined benefit plans, do all these aspects, and then share-based compensation and look at these aspects. So first one, defined contribution plan. Tell me, what is this? Risk is with the employee. Yeah, so you go to your employee, you tell him this is 1,000 additional to you every month to take care of your pension expenses. Now it is your responsibility to invest. It is your responsibility to ensure that this amount is sufficient to take care of your retirement expenses. So that means you just pay him a monthly amount. You don't have to create any asset. You don't have to create any liability. So what should be the treatment on income statement? It should be shown as expense, and we would classify this under the employee expenses. So employee benefit expenses, which will have salaries, which will also have defined contributions. What will happen on the balance sheet? Balance sheet, we will reduce cash. Should we create a liability? Should we create an asset? No, because we are not making any commitments. And the investment risk is going to be with the employee. Is it smooth? Defined benefit plan. So here we make a monthly contribution, but we do not say to the employee that the responsibility is on you. We take the entire responsibility on ourselves. So this is where we will have to predict all those, or we will have to make all those assumptions, and then we will have to figure out how much amount is to be deposited into your pension trust. So the benefit to the employee, which is pension, is fixed. Then the investment risk is with whom? It is with the employer. Employer must estimate future value of liability. We will have to make a series of assumptions like compensation growth or mortality growth. Then we will also have to maintain separate assets. So you cannot wait for the 25th year to come to start making deposits. Right from year 1, you will start having assets and liabilities. And if assets are more than liability, we will say plan is overfunded. If the assets are less, then the plan has to be underfunded. Is that fine? So other plans. So the first one was contribution, second one was benefit. Other plans could be something like healthcare. So whatever health issues your employee will have, those expenses would be taken care by the organization. Generally for these type of commitments, companies do not pre-fund. So they do not start investing into a pension trust to fund these type of expenses, and eventual benefits are generally specified. That means in case of some health issues, there would be a maximum cap up to which employer would bear the expenses. Are we fine here? So let's start with an example. An employee earns 3% of his annual salary for each year of service. So he has 20 years of service, final salary of 100,000. So his pension on retirement is going to be 100,000 into 3% into 20 years, which is going to be 60,000. Okay, so let's do an example. So we have an employee who's hired in 2008. He's being promised 2% of final annual salary multiplied by number of years of completed service. Starting salary is 50,000. Discount rate is 8%. Compensation will grow at 4%. He will work for 25 years. He will live for 15 years after retirement. Just hope that your employees do not know in advance what assumptions you make for them. And calculate PBO, which is essentially his liability in 8 and in 9. So what are the steps? Or do you want to try first? Give it a try. Should we do this together? Step number 1. Find out what should be his last salary. So the most common trick now here, if he is going to work for 25 years, his salary increments will come only 24 times. Because on day 0, when he joins, he will not ask for an increment. On year 25, when he retires, he will not ask for an increment. So in 25 years, the number of annual increments would be 24. So let's find out the final salary. 50,000 PMT, no, 50,000 PB, 24N, 4 IY, compute future value. 128, 165. So that's his last salary. Then step number 2, last salary into how much percent? 2%. So just 2%. Don't multiply with number of years of completed service. Just last salary into 2%. 2563. Step number 3, this 2563 into number of years of completed service. So that would be 2563 into 1. So if you multiply this with 25 now, what employer will do is immediately at the end of the year he will resign. He will say मैं pension लेने आऊँगा, and then he will go and take up a job somewhere else and again resign in a year's time. So even though it should be 25, if he works for 25 years, so that vesting will happen every year on a year-on-year basis. So we just multiply with 1 right now because that's what he's really earned at this stage. So every year we should be making him a payment of 2563. Step number 4. Now this 2563 is the first payment we make in year 26, then 27, and we make how many payments? 15 payments. So we will find out present value, and that value will come on which date? Year 25. So second clear TVM, 2563 payment, 15N, because those are the number of payments we're making to him. So 15N, 8 IY, compute present value. 21, 9. Is this correct? So your liability at the end of year 25 is going to be 21940. Let's find out the present value of liability. Please take cognizance of the fact that we are at the end of year 2008. So when you discount back for 24 periods, not 25. So second clear TVM, 21940, future value, 24N, 8 IY, compute present value, 3460. So that's your liability for year 1. Any questions here? No? Now, do you want to try 2009? Do you want me to repeat this again? Are you hungry? Thirsty? क्या problem क्या है? Do you want me to repeat this again? No? Have you understood this? No? Yes. So try doing this for 2009. Try doing this for 2009. Alright, so how do you do this for 2009 now? Again. Will last salary be same? Nothing changes. Last salary into 2% will also be same? Yes. It will be same. But now the number of years he's completed his service would be 2 years. So he will be wasted one more. He would be wasted one more year. So now if this is the case, you don't have to do TVM again. Since your payments are doubled, automatically your present value would be doubled. Yes or no? If your payments are doubled, then your present value here at time 4, at step 4. So this would be multiplied by 2, which would be, how much is that? 43880. So now at the end of year 25, your liability is 43880. This time when you discount backwards, you'll discount backwards for 23 years. So now your PBO would be how much? 74. Want to do one more? Yes, no? I want you to write down these steps. So later on when you revise, it would be much more easier if you follow these 5 steps. Expense will come slowly. Okay. Now I'm going to build a comprehensive example. So if you revise this example, most of your employee related concepts would be fine with. So on this example, we will see how do we do the calculations on balance sheet, and we also see what impact will that have on your P&L. We will integrate them together. Let us say the starting salary is 70,000. Then number of years that employee will work for you, 30 years. Then the formula for pension calculation, 3% of last salary into number of years. 3% of last salary into number of years. Discount rate 12%. Compensation growth rate 5%. Then expected pension annuity payments 20. That means post retirement we will have to make 20 payments to the employee. Do we have all the data? So what I want you to do is find out what should be the PBO. What should be the PBO in year 1? Find out PBO in year 2. Find out PBO in year 3. And try to do this in the context of those 5 steps so that when you revise back at home, it becomes easier. So step 1, 2, 3, 4 and 5. So let's do this together now. Step number 1, figure out what would be the last salary. So your N is going to be how many years? 29 years. And then you would grow this at what rate? 5%. So how much is the last salary? 288 129. Then step number 2, 288 129 into 3%. How much? 8644. So 8644 or 43. Then step number 3 onwards, the calculation will change for every year. So for the first year, 8644 into 1. Now I'm building a small timeline here, just a graphical representation. This is going to be very handy when we do a slightly more detailed analysis. So first year, we are every year going to pay 8644. What is the present value of this 8644 for 29 years? Because we are calculating at the end of year 1. Present value of 8644 being the payment for 20 payments, and discount rate would be 12%. So how much is that? 6,455,565. So present value of these 20 payments at the rate of 12% would be 64565. And then you would discount 64565 to today. That would be 29 years at what rate? 12%. How much? 2413. That's it. So your PBO, pension benefit obligation, liability on account of recruiting employee and taking commitment, first year would be 2413. Is that okay? Now what happens next year? In step number 3, now that 1 changes and now we actually multiply with 2. So if you multiply with 2, the amount of pension every year now gets doubled. So instead of 8644, now it would be 7217,288. So this is the amount now we would be paying to him every year. These 20 payments we will discount and find out a liability at the end of year 25. So how much is that liability? 129128. And this liability we will discount backwards for 28 years. So that would be how much? 5406. So this is 5406. In year 3, now that he's worked for 3 years, we will multiply this number with 3. So how much is the pension every year? 8644 into 3. 25932. Then this 25932 we will discount 20 payments 12%. So we'll get a liability at the end of year 25. How much is that? 193697. 5. So 193697. Now this liability we will discount backwards for 27 years. So how much is that? 9083. So 9083. So up to this is what we have already learned. Now we want to go a step further and diagnose that what are the reasons why this liability is increasing every year. So your liability every year is increasing on 2 fronts. The liability every year is increasing on 2 fronts. On one front, it is increasing only because of the time value of money. Because in the last step, step number 5, first you discount it backwards for 29 years, then 28 years, then 27 years. So because you're discounting backwards for lesser number of years, the liability anyways is going to increase. Second, that liability is increasing more because your employee worked for 1 more year. So because your employee worked for 1 more year, some part of your liability is increasing. This employee worked for 1 more year, this component going forward would be referred to as the service cost. The amount of liability increase because employee is working for additional year is service cost. I'll give you time, just focus. and this component going forward would simply be referred to as the interest cost. So if I give you the opening amount of liability, if I tell you what is the interest cost, what is the service cost, you would easily be able to find out what is the closing amount of liability. Interest cost is extremely easy to find. Opening liability into what is the discount rate. So if you do 2413 into 12%, 2413 into 12%, we will get the interest cost, which is how much? So 290. So that's your interest cost. Now listen to this part carefully. When your employee worked for 1 year, you were supposed to pay him 8644. But if you worked for 1 more year, then that annual pension got doubled. So because he worked for 1 more year, every year now you'll have to pay 8644 extra for 20 payments. Should I repeat again? पहली बार बोले आज. So when employee worked only for 1 year, you said we will pay you 8644 for all those 20 years after your retirement. But the moment he finished his second year, you told him that now every year you are eligible to receive 17288. So how much extra is he going to receive every year? 8644. So that 8644 we have to pay him every year extra because he worked for 1 more year. So technically that's your service cost. But that's happening way in future. So we need to discount that to today. So step number 1, find out the present value of that incremental 8644 on year 25, which you already have, which is 64565. If you take present value of that incremental 8644, 20 payment, 20 as IY, that present value in year 25 has to be 64565. But that liability is at year 25. Today we are in year 2. So that 64565, let us discount that backwards for 23 years at the rate of 12%. So let's do this. Second clear TVM. 28 years, sorry. 64565 future value. 64565 future value. 12 IY 28N. 28N. Compute present value. 2703. So let me write that here. That's 2703. Now you add up 2413 plus 290 plus 2703. And then that would be 5406. Now of course there was a shortcut to get 2703. If you do 2413 into 1.12, you can also say 5406 minus 290 minus 2413. But see, logically that 64565, when you discount that for 29 years, you get 2413. So when you want to discount for 28 years, just multiply 2413 with 1.12 and you would get the value service cost for next year. Have I complicated this? Are you following what's happening? Should I repeat again? Maybe second year का करते हैं. अब और एक बार पकड़ने का कोशिश करो. So again, why is your liability increasing? One, because of interest cost. Second, because of service cost. I'll give you good time to write. I just want you to focus right now. Interest cost would be 5406 into 12% again. So find out how much. 648. Now, how to think of the service cost? Because your employee worked for the third year, now instead of 17, every year you will have to pay him 25. So that means every year you have to pay him an additional 8644. These additional 8644 we are going to pay for 20 years So if you take present value at year 25, that has to be 64565. This 64565 we will discount backwards, this time for 27 years. So do it. 64565 future value, 27N 12YY compute present value, 3027. And now see if it works. 5406 plus 648 plus 3027. 5406 plus 648 plus 3027. Is it telling? Now the shortcut to get this 3027 is multiply 2703 with 1.12. Why? Because in one case you discounted for 29, then 28, then 27. Just have a multiplication of 1.12, you directly get that value. But that's how you calculate. The thought process is here. But because you're paying extra, whatever extra you pay, discount that backwards to today. Have you followed this? So that gives us an equation which is opening PBO that will increase every year at least by two components. One, interest, second, service cost. Interest is simply TVM. Because we are going forward, automatically that liability will keep on increasing in size. Service cost, because your employee is working for one more year. So because he works one more year, every year you end up paying more pension. So that present value of that incremental pension today is the service cost of the employee. Are we good with this? And then apart from this, in the next session we will learn that there could also be certain changes. For example, originally you thought that the salary of the employee will grow at the rate of 5%. But it turned out that employee was quite smart. So instead of 5, now his salary is growing at 8%. Possible? I mean, you don't do this per employee, but maybe all the employees were very smart. Or maybe the inflation rate increased. है ना, कुछ भी हो सकता है. So then if your assumption changes, automatically then everything else is going to change. Are you following this? So we call this as actuarial changes. I mean, you change your assumption, so we have to make adjustment. Or the company may change policy, and to the every employee it would go and say, instead of 3%, now we will pay you 4% of final salary. So this is called as plan amendments. So you can change structure of your plan, that will again increase your liability. Are you following this?